Good morning, everyone. Thank you for joining us for this morning's webinar, Things You Need to Know About Private Equity. This is Steve Mills, and I'm joined by my colleague, Justin Horner. We're going to spend a little bit of time going through really an educational process about what private equity is, and then how people in our position as sponsors of private equity funds actually take a look at investments and think about the opportunities. Before we get started, just want to briefly remind you that DCA Partners is a full-service mergers and acquisitions firm. The other portion of our business provides investment funds through a private equity fund to make investments in underserved geographies here in California across a multiple of industry sectors. Let's get started this morning, and I'm going to turn it over to Justin.
All right, good morning, everyone. So we're going to start with a little bit of background on what private equity is, just so that we're all on the same page. And to give you a sense for how we define private equity, we see private equity as medium to long-term financing. So we generally think about that as 3 to 7 years, provided in return for an equity stake in the business in solidly performing and growing privately held companies. So it's generally event-driven capital. And so when we talk about event-driven capital, we think about expansion. So if a company needs to open a new office in a new region, develop new products and capabilities, or hire new talent, the capital can be used for that. And there's generally not debt available to undertake those kind of strategic initiatives. It can also be used to make acquisitions and cover the equity portion that debt will not cover, and that can be for vertical or horizontal integration. Recapitalizations of the business, so to the extent a company has too much debt and would like to convert some of that debt to equity, or at least bolster the balance sheet and take on some additional debt, can be used for that. We also do partner and management-led buyouts, and we'll often find that there are business owners that have reached the end of their career, and rather than sell on the open market, they like to pass it on to their existing management team, and we can come in and sponsor that management team to complete the buyout and then help build value from there. Another option is shareholder wealth diversification. And so at times, to the extent owners like to leave capital in the business and have lived a meager lifestyle, as they get older and they may want to either fund their retirement accounts, or pay for college, or just live a little bit better lifestyle, we can inject capital into the business that they can then take off the balance sheet to live the lifestyle that they want to live. To give you a sense for the landscape of the private capital markets, private equity sits right in the middle. So generally, as companies start, their startup capital is provided by friends and family and angel investors. Then if they're growing quickly enough and they're in an interesting enough space, they can take venture capital, and that all funds exponential growth. As the company starts to stabilize and has generated somewhere between 5 and 10 million in revenue generally, and has EBITDA that's positive, they can then take private equity funding, and that again is to support additional growth, rapid growth, and expansion across the business. As the company reaches its stabilization point later in its life cycle, often strategic investors will get involved, and that can be through partnerships or straight investment. And then obviously as a company declines, their special situation funds that can provide capital in those situations. The structural components of capital, so this is what we call a capital stack. At the top, the lowest risk capital that's generally in a business is senior debt, and that's provided by banks. It's the lowest risk and therefore the lowest cost. There's generally collateral required to back up the loan, and then there's also financial and negative covenants, and personal guarantees generally from the ownership team or anyone that owns more than a certain percentage of the business. If a company needs additional capital beyond that, they can start tapping into the private equity markets. A debt option within the private equity space is mezzanine capital. It's higher risk and therefore it's higher cost. It sits behind the senior debt, so your senior debt's going to have a first lien on all the assets of the business, and so in the event that the bank forecloses on the company, it's going to get paid back, and the second to get paid is the mezzanine capital. So with that higher risk comes a slightly higher cost. There's also generally some upside for the mezzanine capital investor. It typically comes in the form of warrants. which is just effectively the ability for the private equity fund to sell shares at a later date for the current price. They're also covenant light, and there's generally no guarantee with those, although that's not always the case. Next up is private equity, and this is true equity that's coming into the business. If it's a minority share, the private equity fund has a preference, which means that in a liquidation scenario, the equity firm gets its capital back plus a preference and then participates in the common, or may not participate in the common, but there are preferences that exist. It's higher risk because you're nearing the bottom of the capital stack, and so therefore the cost is a little bit higher, but the benefits are that there's no collateral, there's no operating covenants. It can come in the form of majority or minority equity, and you generally gain a strategic partner in that process. And finally, at the bottom is common equity. So there's no preferences, and everybody just participates on an equal basis at exit. So why invest in private equity from an investor's perspective? The benefits are that over the last dozen years, private equity has greatly outperformed venture capital and the public markets. It's generally less volatile, and so you're not looking at daily market fluctuations. You're looking at long-term growth. Again, you're sort of looking with a 3 to 7 year horizon, and so you're not, you're not looking at the Dow changing, day to day. It's actively managed, which is a benefit. So you have some intimate knowledge of what's happening within the business. You've got a professional investment team that is actively looking at the business and helping with strategic initiatives and providing resources to the business to ensure that they're successful. And that all drives higher historical returns. The drawbacks, again, actively managed shows up on the drawbacks. So to the extent the equity fund is either not the right partner, or maybe they're busy, or they sort of lose sight of what's happening within the business, and they are no longer actively managing that, even though they should be, it may be detrimental to the performance of the company. And so you really want to ensure that the equity fund that you choose to invest in has a strong management team within it that's capable of leading those investments. There's limited access, so you have to be a qualified investor to invest, and there are often minimums. So access, it's not the same as the public markets. There's a lack of liquidity, so you can't kind of buy in and sell out of a fund. You're generally signing up for at least a 10-year commitment. And sometimes, there's generally 2-year extensions, so it could be up to 14 years. Although as you buy in and sell out of deals, there's some ongoing returns throughout that lifetime. The fees are generally higher than brokerage accounts, as you would expect. And once you commit, as I mentioned before, you're committed for 10 years. And the valuation of the portfolio companies is subjective. So you don't have an active capital market that's revaluing the business on an ongoing basis. It's subjective to the private equity firm that made the offer in the first place. And so when you're thinking about kind of investing in private equity, or whenever anyone thinks about private equity, they want to search for the right general partner. And so you want to look for market experience, alignment of interests, and a reasonable fee structure. And that is generally going to provide a good investment vehicle with positive returns. And at this point, I'll hand it off to Steve Mills to talk a little bit more specifically about what investors are looking for.
Thanks, Justin. We're going to take a look through the next few minutes at how a private equity fund actually analyzes an investment opportunity and try to provide a basic understanding of the thought process that we go through. From private equity investors' perspective, there are a number of different things that we take a look at that are all integral to making the decision whether or not to invest in a portfolio company. Those items include the market opportunity, obviously the management team, and I would say that we probably take a look at the management team first. If that doesn't pass the review hurdle that we have and our analysis and assessment of the team, we probably won't go any further than that. We'll also take a look at who else is in the space, what is the competitive strategic advantage that they have versus the other competitors in the industry. what is the total addressable market? That's called the TAM. That's typically expressed as the market opportunity. How big is the opportunity for this company to pursue? We also take a look at scalability. It's one thing to have a good idea, but can the opportunity actually scale across significant growth that we would anticipate during the holding period of our investment? Finally, one of the things that's really important to us is to make sure that the management team is aligned in terms of the goals and objectives of the investment. We typically model our investment horizon over a period of 5 years and expect that at the end of that 5 years or within that period, we'll have enjoyed a liquidity event. If management is not interested in that type of outcome, for whatever reason, they decide that they want to create a lifestyle business, they want to pass the business down to their heirs, or whatever. If they're not aligned in terms of having an exit within that horizon, it's probably not something of interest to us in terms of making an investment. When we take a look at the management team, and I told you a moment ago that that was probably the most important factor that we take a look at, some of the things that we evaluate are their domain knowledge and expertise, their relevant operating experience. What's their track record? Have they done this before? How well do they work together? Have they worked together in the past? Where are the gaps in the organization? We try to assess all of these things, and obviously no company has all the boxes checked. So then again, taking a look at this, trying to understand where those gaps are, it also provides us with insight as to where we might be able to add value as it relates to augmenting and enhancing the management team. We talked a moment ago about the total addressable market, and one of the questions that we obviously want to ask is, why is the company pursuing this particular market? What's the customer value proposition? Why do customers care? Why do customers buy? Obviously, the general explanation there is that the product or service that's provided by the company saves time, money, increases revenues, or decreases costs. We take a look at the size of the market. What is the addressable market? And probably as important as trying to define the addressable market is to understand exactly what segment the company is working in. The segmentation is important because oftentimes the segment is much smaller than the addressable market, and you need to make sure that, again, the segment has potential for significant growth over time. What's the market share that they have presently? What could they aspire to with additional capital and resources over the holding period that we're looking at? Are there opportunities to expand or extend into adjacent markets? Those are the types of issues that we'll take a look at when we try to size the market. One of the other things that's interesting, at least in our experience, because we tend to invest in later stage companies, the time to market is really important. And oftentimes, the first to the market, although you will hear about first mover advantage, oftentimes it takes a significant amount of education to educate the marketplace about the particular product or service that's being offered. And to the extent that you can become a second mover, you're able to leverage that prior experience and the costs that were incurred by the first mover. And the second mover probably isn't a bad place to be. One of the examples of that that's grown a very significant business over time is Microsoft, as I'm sure you're well aware. Same thing with Salesforce. They're doing a lot with purchasing additional functionality in the marketplace. The third example of that, of course, is Oracle in the software space. Finally, we try to take a look at and understand the differentiation of the company's product or service in the marketplace. What is their value proposition? Why do customers buy their particular products? What are the unique attributes? How sustainable are they? And are they predicated upon or based upon intellectual property? To the extent that we have competitive advantages from unique attributes that are sustainable and then protected from an intellectual properties perspective, obviously that makes for an attractive investment opportunity. Same thing in terms of taking a look at the market opportunity. Now we get into some of the tactics and the basics that we want to understand about the company. What is their go-to-market strategy? Is it an indirect or a direct sales model? How do they manage their channel relationships? Taking a look at the pipeline, we actually want to know what their sales pipeline looks like, and then also do a deep dive into the competitive situation. Why have they won recent clients, and why have they lost recent clients and proposals? Finally, it's really important for us from an evaluation perspective to be able to take a look at customer references. We'll typically do an in-depth interview with a number of key customers, taking a look at why they selected this particular company's product or service, what other companies and alternatives did they consider, and what's the relationship like with the company? Is it a smooth relationship? Is it a contentious one? We oftentimes ask how things can be improved, not only from a relationship perspective, but also the product. So customer references obviously are very important in the evaluation process. Throughout the discussion, we've also talked about trying to understand what the competitive landscape looks like. The question that we ask the company is, why do you win? Who are the current competitors? What characteristics do they have? In most cases, there are competitors in this space that have more resources, and the resources can be in the form of cash, human resources, or strategic relationships. And oftentimes, you're going to have to be able to understand where you compete, how you compete, and how you can win against the competitors by taking a look at their offering, their position, the distribution, and their intellectual property. One of the things that a lot of companies also make the mistake in doing is saying, we don't have any competitors. Well, we all know that that's not true. It means that if they say that they just haven't looked hard enough to evaluate the competitive landscape and identify those competitors. All of the competitors in the space will respond, and smart companies try to figure out how they're going to respond ahead of time to be able to take action to mitigate those adverse responses from the competitors. The other thing that is probably important to take a look at as it relates to competitors are who might be competitors. You know who the competitors are in the space presently. The real question is who from outside the current ecosystem might decide to become a competitor, and again, thinking through their characteristics, how they might respond, how they might enter into the market is an important aspect of evaluating the competitive landscape. Finally, in some businesses, there is structural risk, and when we think about structural risk, typically it's governmental or regulatory or international risk associated with just the industry generally. So when we think about structural risk, it's really risk to the industry, and then more specifically, how that impacts the company that we're evaluating for investment. As an investor, one of the things that's really important is how and when do I make money? Obviously, the financial model is a crucial part of the analysis that we go through, and typically management's put together projections, and that's very, very important. However, we also then will build a model based upon those projections to take a look at some of the key assumptions and what are the drivers of the business, what's the cost of customer acquisition. Do they have the ability to deliver either the products or the services that they projected in their forecasts? What's the technology and product roadmap look like? It's one thing to be selling what you've got now, but all businesses have to continue to evolve and improve. And we typically like to take a look at what that roadmap looks like, and then also what the costs associated with that development might look like. We try to identify milestones, and oftentimes those are quantified as financial metrics such as revenue, EBITDA, customer retention and churn, market share, product release timing, and things like that as it impacts the financial model. Sensitivities and understanding what they are and how they impact the financial projections is really important. Rate of growth, margins, obviously the number of units sold. These are all the basic type criteria that go into modeling, and clearly you want the ability to toggle or at least change the assumptions in those areas to allow you to evaluate alternative outcomes as it relates to the financial performance of the company. Then finally, try to take a look at what the dependencies are. What do we need to have in place before we can achieve the results that are forecast? To the extent that there are gaps, what do we need what are those gaps, and what do we need to do to fill those gaps and address them? And finally, is there innovation that's required to be successful? One of the things that we talk about is trying to mitigate at least our investment risk by making sure that there isn't technology risk or development risk associated with our investments. What we like to focus on is what we call execution risk. And what that means is basically that we're investing in companies that have a proven product or proven software or proven service. And all we have to do is become more effective at growing the business through sales, improving the margins by taking a look at efficiency opportunities, and then increasing the revenues through expansion in other geographies or perhaps adjacent sectors. So how and when do I make money? Really important. Now we get in again to the tactical side of it. We typically want complete financial statements, which include income, statement of cash flow, and balance sheet, typically 3 years on a monthly basis. We'll take and use that information, benchmark it against industry and the industry and competitors to figure out where they fit on that continuum. And then also try to answer the question whether another round of financing or a subsequent round of financing is going to be required. And if so, what's the catalyst for that to occur, to make it, to require it to be done? What's the timing? How much is it going to be, and where is it going to come from? You want to make sure that you understand what the cash requirements of the business are, and obviously that includes, at least from our perspective when we model it, a hard look at just the cash flow from the business. The next item that we want to talk about just quickly is valuation. And the rule that we have is that the investor sets the price and the customer or the company selects the investor. All investors invest with the expectation of receiving returns. Different funds require different rates of return. As a later stage company or a later stage private equity fund that invests in later stage companies, we typically accept a lower rate of return just because we don't expect our investment to go to zero. Venture funds, on the other hand, will make 10 investments and expect one of them will have to return the fund's entire investment, just given the fact that it's likely that the other 9 will either break even or not return a significant enough amount to make the fund viable on a long-term basis. We also take a look at the current capitalization table, prior financing and terms, and then want to make sure that there is an adequate option pool available for employees, because we think that options and ownership are an important motivating factor for employees of the companies. How do we take a look at valuation? Basic methodologies that I'm sure you're all familiar with: public company comps and precedent merger and acquisition transactions. We take a look at multiples of revenue and EBITDA based upon those comps. Sometimes, or not sometimes, we actually will typically discount the pro forma financial statements that are prepared by the company, being, or at least tending to be, more conservative than management, so that we make sure that we have the ability to actually meet the projections. And then obviously we'll take a risk adjustment as well, based upon the gaps that are present, resources that need to be filled, and adjust the valuation in that fashion as well. Terms that are important for you to understand are pre-money and post-money value. Simply put, pre-money is the value of the company prior to making the investment. Post-money is that value added to the capital that's actually put into the business. And then finally, as we take a look at the valuation, what's the timing of the likely exit? Is it going to be an acquisition or a merger, or is it going to be a recapitalization? Any of these types of liquidity events are acceptable to us. It's just important that we sort of begin with the end in mind, understanding who the likely acquirers are going to be, and then make sure that we've built relationships with them so that we become the absolute have to acquire or partner with company when it comes time for a future liquidity event. The other side of the equation, when we talked about the company actually selecting the investor, some of the things that the company is probably going to want to look at, and smart CEOs and CFOs do, is they take a look at the personality and fit of the potential investor. They will typically do reference checks to see how we behaved with other CEOs and other board members of other portfolio companies. They'll also take a look and try to evaluate our commitment and our willingness to participate in addressing the issues associated with the business that occur typically on a daily basis, whether it's from just being a sounding board for the CEO or the CFO, all the way to the formal board meeting participation that we provide. They'll typically ask about our experience and whether or not it's relevant to the nature of their business. Oftentimes, experience can also come from prior experience that the investors have had as operators in the form of managing operations, financial expertise, or technical expertise. The question that we always get then too from the companies is, where are you going to add value? Are you going to bring relationships to the table? Are you going to bring customers or potential customers to the table? How do you help us expand our distribution and sales channels? What type of strategic partner or acquirer relationships do you have? And again, the operational expertise that we talked about as well. And then for companies that need multiple rounds of financing, oftentimes they will say, well, can you make introductions to the source of the next round of financing that we have? And again, obviously, that's important to them. Finally, the other things that they'll typically look at are management and governance. What value do we add there? And whether or not we have the ability to participate in future rounds of financing. We mentioned this earlier. Exit strategies are obviously important. We try to understand what that's going to look like before we make the investment. And the typical exits that you'll see here, sale to a strategic, sale to a financial acquirer, a redemption by the company, or an IPO, are all alternatives that we've employed in the past, with the exception of the IPO. We have not worked with companies, at least in our funds, that are of sufficient scale to be attractive to the public markets. One of the other things that we're seeing right now is a significant increase in the willingness of financial investors or acquirers to pay up and pay strategic value. So what used to be generally associated with the premium value of a company by a sale to a strategic acquirer, we're now seeing financial acquirers also stepping up to the plate at those valuations, which actually has caused more competition for good companies in the liquidity events and the liquidity markets. The next thing that we wanted to go through is just help you understand what the returns waterfall looks like when there is a liquidity event. It's probably pretty straightforward and also follows the capital stack that Justin described earlier. When there's a liquidity event, the first thing that occurs is obviously the senior debt gets repaid, lines of credit, term loan, equipment loans, and so on. Then, to the extent that there's cash left over, it trickles down to the mezzanine capital level, which can include term debt, a royalty finance arrangement, and requires a warrant payout at that point in time. To the extent that the capital is left after the payment of the senior debt and the mezz, then it will be allocated to the preferred equity, and oftentimes it's a return, because it's called preferred, it's a return of capital plus a preferred return, and in some cases there's participation with common. Finally, after the preferred equity preferences have been satisfied, the remainder, if any, will go to the common shareholders. What's the process look like? The process can last anywhere from probably 3 months to maybe as much as 6 months, depending on just the readiness of the portfolio company for investment. But clearly it starts with the term sheet, and the major terms in the term sheet address valuation, governance, preferences, terms and conditions, and will oftentimes include an exclusivity period within which then the private equity fund can do its due diligence and evaluate whether it wants to make an investment or not. At least the way that we operate, typically by the time we've issued a term sheet, we like the company, and think that unless information comes up during the formal due diligence process that would indicate that we shouldn't make the investment, the diligence process is more of a formal situation where we actually go through and confirm what we've already been told, reassuring ourselves that what management's represented is accurate. And from a financial perspective, we understand the budgets and the model that they put together. And then, as I mentioned earlier in the presentation, we go through a reference check as well. The definitive documents is a straightforward process. Good transaction attorneys can save you lots of money to the extent that they know A, what's in market, and B, how to understand and read the various provisions that are in the documents. Attorneys that aren't experienced in that fashion oftentimes can cost the company a significant amount of money as they try to understand and learn on the job going through the documents. And also, to the extent that that delays the process, it can and has in other circumstances that we're familiar with, jeopardize the closing of the transaction and the financing generally. Then, obviously, the closing is a straightforward process. You sign the docs, you send the money, you receive the stock certificate, and everyone's happy at that point in time. Probably the most important aspect, though, of making the investment, you've gone through the formal process, you've got everything documented. It's really what happens after the certificate has been exchanged for the cash, and that's the execution against the plan. We think that it's absolutely critical to make sure that management has a plan in place that provides accountability, reporting, and specific goals and objectives that we can manage to and help the management team manage to. Without that plan in place, obviously, we don't think that it makes sense for us to make that investment. So one of the commitments that we have with our companies is, as is the case with many other private equity companies, is that they also require a plan be put in place immediately upon the investment, and that obviously provides then the structure for us to manage our investment going forward. 2 quick case studies for you. We invested in a marketing survey and software services company that used the capital for expansion and software development. We ended up meeting the CEO while attending an industry conference for entrepreneurs. Where did we add value in the process? We provided strategic and financial advice during the economic downturn while they continued to develop their product. We provided interim CFO services, and ultimately were involved in the selling process. The revenue grew from 6.7 to 25.5 million over our holding period. Employees went from 69 to 141, and we ended up, as you can see, we had put 1 million in and ended up getting 6.5 times that back. That for us was a successful investment. I think we provided significant additional value to the company. And if you talk to the CEO, I think he would confirm that this was a great outcome for both the company as well as the investors. The second case study that we had, it was a managed vision care provider. We basically came in, made an investment to take out a strategic investor who was no longer strategic to the company. They wanted some additional growth capital, so not only did we relieve them of an investor that wasn't providing value any longer, we also provided them some additional growth capital. We were able to also help them during the period that we held the investment obtain a $25 million debt facility, and a portion of that was used as a dividend during our holding period. During our holding period, revenue increased from 80 to 134 million, employees from 84 to 116. And in this case, the transaction value when we went in was a combination of debt and equity, or a $54 million transaction. And our returns on that was basically a 3.2 cash on cash and an IRR of 26.5%. Again, this was a little bit more mature company, but I think if you talk to the CEO, he would agree with us again that it was a really good outcome for both the company as well as our fund. That's it in terms of the formal presentation that we have. We have a little bit of time left over, and would like to open it up to questions if we can. I believe that on your screen you can type in questions, and to the extent that you do, we will try to answer them. Let me start with the first one that we have. The question is, how do you assess the competition in your funding space? Justin, you want to take that?
So I guess the way I understand the question right now is how do we think of other private equity funds in our space, effectively direct competition to DCA? I guess from that perspective, it's interesting. There are funds that compete with us, and often they're a competitor and also a partner. So we have several funds that we co-invest with, and so we will often run into them as a competitor where they've got the ability to write the whole check, and we have the ability to write the whole check, and it comes down to who's going to provide better terms to the business. And the flip side of that is, often we'll get together when neither one of us has the capacity to write the check, or neither one of us wants to take the full risk of the deal, and partner up and work together. So private equity is a competitive space. There is a lot of dry powder out there, but we all tend to try to work well together because we also need each other. So I don't know if that fully answers the question, but that's how I think of it. I try to be as helpful as I can to other funds to the extent there's deals. Also, I guess another component of that is that we don't all focus in the same space. And so there may be, funds that have a specific area of expertise where they're going to add a lot of strategic value, and it may be a better fit for them than it is for us. And so we can make referrals in those spaces. And so again, we like to just know everybody. The one that's top of mind to me is in the ag space. There's AGR locally in Davis. I think they've got a tremendous team. They're able to write significantly larger checks than we can, and they're experts in the ag value chain. And so to the extent we find deals that don't fit our model or might be a better fit for them, we're happy to make referrals there.
Take the next question. What incentives do you prefer for executives and employees in your investments? I think that I'll answer this one. I think that the incentives are consistent with what you would see across industry generally. Typically, there's a base comp of cash, and that is whatever is appropriate for that particular level and experience of the executive. On top of that, we oftentimes think that it's really important to have an additional cash component in the form of a bonus opportunity. And typically the bonus opportunity needs to be dependent upon two things in our firm, one of which is the overall profitability of the portfolio company, and then also whether or not the executive or the employee has been able to achieve the agreed upon objectives that allow them to earn the bonus. So it's, if you will, performance-based, both at the employee level as well as at the company level. Then on top of that, obviously, we think that there's value in being an owner in the business, and so recommend that our portfolio companies set aside an option pool that allows executives and employees to actually earn ownership over a period of time. Typically, the way that we look at vesting is a cliff vesting of 25% at the end of the first year, and then 1/36 of the remaining balance over the next 36 months. So it's a total vesting period of 4 years. Next question. I'll take this one as well. What do you look for in potential investors in your fund? What we like are investors who not only obviously have the financial wherewithal to participate in the fund as an investor, but also have, to the extent that at least they're individual investors, an interest in a particular industry, an interest in potentially becoming an advisor to us or potentially one of our portfolio companies. Said another way, we like people with industry experience that obviously augments our experience, and we think that, you know, to the extent that there is a willingness on their part to participate, we welcome that and enjoy working with our investors. Not all investors obviously are interested in doing so, and so to the extent that people are not, that's fine as well. But again, I think it's important that investors understand how private equity works to make sure that expectations are appropriately managed. And then to the extent that they're active or they're interested in becoming more active in the process, we're certainly open to that. What are some of the ways, the next question, what are some of the ways you determine market size opportunity, especially with unique geographies that a company may be operating in?
So, you know, this is Justin. From my perspective, we look at it a number of ways. You know, the world has gotten a lot smaller, thankfully. So, you know, companies that are in the Central Valley or maybe in Reno, some smaller markets, have a lot more access than they used to. And so I think geography is less important to some degree, depending on the business, because there's access and availability. And to the extent the geography isn't a good fit for growth, we can take a look at making acquisitions into new geographies or potentially, you know, building a new operation in a new geography to gain market share there. So we'll look at the market as a whole and then the segmentation that they're within, get a good sense for that. And then a lot of where I think the real value is just making sure that the market is big enough as it generally, but then where I think the focus is looking at their ability to execute and making sure that they have, you know, the right sales team in place, that they're focused on the right customers, that the cost of customer acquisition is low enough that they can then execute against a growth plan over the next 3 to 5 years that's going to be sufficient to at least double revenue within the business, potentially triple or quadruple revenue within the business. And so to the extent the market's large enough to do that, you know, I think we're pretty comfortable. And then it comes down to, are they capable of execution?
Next question. In what other ways besides compensation do you get involved in ensuring that the company acquires, engages, and retains key talent during the growth process? It's a great question. What we've done in the past is, first of all, develop job descriptions, trying to assess what's necessary for the company from the job description or the function. Then obviously help them recruit personnel both directly and also participate in the interview process that companies go through. One of the other things that we've done in the past, I have actually gone in and interviewed staff on a periodic basis, trying to understand where things are within the organization, spend time interviewing the C-level executives and directors or vice presidents that actually are responsible for functional areas. Have done one-on-ones with all of those executives in our portfolio companies. So in terms of trying to be engaged, obviously look at the relationships within the organization, gaps within the organization, and then try to provide advice and counsel and mentorship as appropriate with with the executives, primarily with the executives.
I would add to that we can get a pretty good sense for how the employees feel about the management team when we do a walk around of the business. It's interesting to see, you'll walk some companies and get introduced around, and the employees will say, "Hey boss, good to see you. Hey, how's your wife doing? How are your kids doing?" You can tell there's a personal relationship there and that they're happy within their job. There's other companies that you walk and you get the sense of like, oh great, this guy's around again. And so if we start seeing activity like that, we'll both evaluate it on the front end to make sure that the management team is what we think they are and coachable. And then as Steve mentioned, we'll provide counsel and some oversight to the management team to help ensure that they retain key employees.
Are there any additional questions? We've gone through the ones that we've received thus far. If there aren't, I guess the final plug, we have Fund 2 closed. We hope to be looking at a Fund 3, starting that process in 2019. So to the extent that you have companies that it's important for us to take a look at and begin to track and build relationships with over the next 12 to 18 months that could be potential portfolio investment opportunities, we certainly would welcome those referrals. We think it's important to establish those relationships before making a decision of whether or not to invest. And then secondly, to the extent that you're interested at some point in evaluating whether an investment in private equity might make sense, please drop us a note and we'll be able to put you on our mailing list, let you know as our fund and funds continue to evolve. Thank you so much for spending time with us this morning. We look forward to meeting you in person. Have a great rest of the week. Take care.